Hi, welcome back to Academic Market Insights. Today, I'm so excited about this. We are in for a special treat. So, we are going back and discussing our favorite topic, VIX, right? Dr. Rowe, favorite topic,
Yep.
right?
Oh, by far.
Absolutely.
Absolutely.
By far, favorite
Absolutely.
topic. And what's unique about today is this video will most likely be a little bit longer. Yeah, that's good. That's good. Yep, putting to the
Yeah.
VIX. Today
Yeah.
it's going to be a little bit longer, but Dr. Rowe is willing to do an actual presentation that he does in his graduate level classes. And I, this is the exciting role that I get to play today, will be the obnoxious student that will be asking all of the questions that, let's face it, we all have, but
Mhm.
sometimes we don't want to ask. So you will be able to see the real discussion of how we would actually present this in class and get some hopefully deeper insights on what the VIX is, how it's utilized, and really some of these interesting nuances. Dr. Rowe, would you call them
Oh
nuances?
yeah. It's what makes there's a reason you can write a whole book on it. It's so
Or
unique. It's just so unique that it they like Cboe like to refer to it as an asset class. I think it's a tradable asset, but whatever. There's so many things that are different about VIX relative to any other financial future market and index that it really does. I mean, it's got its own trading pit, a live trading pit with people in it still, not just all electronic. So yeah, it's needless to say, it's a unique vehicle. It's a unique market, and it relates directly to derivatives. So I incorporate VIX when I teach even undergrad derivatives, but undergrad and graduate derivatives. And the thinking behind that is just I spent a few years at Cboe and at the Options Institute, and I was kind of the person that focused on VIX among that group of people. And I feel like if someone took derivatives from me and they don't know anything about VIX, I'm doing them a disservice. Maybe even makes me look a little bad that I wasn't able to get that piece of knowledge into their brain, but also may make the institution look bad, et cetera. So I've just always felt like this is something when I teach derivatives that I should definitely be incorporating. The official name is the Cboe Volatility Index into the class. So this
and
is the act. Yep, I was just say this is the actual presentation that I am using for my summer 2025 derivatives class at Kelly.
I also want to comment, it's such, from a research standpoint, from an academic standpoint, VIX is what's used as a benchmark.
Mm-hmm.
So, from a research standpoint, I know I was introduced to it really in my doctoral program because I was looking at volatility of the carry trade, but we compare it to
Mm-hmm.
VIX. So, Dr. O had some major fans at my institution. And again, it's just one of those topics that's, if you're not taking his class, even at a graduate level class, you're not going to get this topic. That's what makes Dr. O so special and unique. And for those of you who do have him as a professor, I say kudos to you because this is a special thing that you're not going to get elsewhere. Now, having said that, if you like this video, please hit like. And if you haven't already, please hit subscribe. Also, again, we're academics who love sharing, discussing things that we would talk about in the classroom and things that we wish we could talk about in the classroom. So if you have suggestions, recommendations, constructive feedback, we are very open to it. So again, super excited. Can't wait to jump into the presentation.
So I'm going to cover all things VIX, and I'm going to start at somewhat of a basic level. I'm going to go through how we determine the value of an option. What are the option pricing factors? Discuss VIX a bit as an index, talk about the futures contracts, how they behave, what's very unique about the futures contracts. And what's unique about the futures contracts, it bleeds over into the option market and it bleeds over into the exchange traded products, the exchange traded funds, and the exchange traded notes that will give you exposure to what I want to call a volatility strategy. So there. And yes, Dr. A.
So, ETPs, exchange traded
Mhm.
products. Can you explain a little bit about what they are?
Sure. Well, most people are familiar with exchange traded funds like the SPY, which gives you uh, exposure to the S&P 500 in a single uh, financial product that trades like a stock. You can also there are ETFs that will do consistent option strategies. There are ETFs that can give you there's an ETF that I believe it's an ETF that gives you exposure to the price of gold for just about every type of investment you would like to give. You got ETFs that give you exposure to bonds. They all trade like stocks, and an exchange traded fund will also hold the underlying securities on your behalf. So if you have an exchange traded fund that is supposed to give you exposure to the S&P 500, it's going to hold the 500 stocks that are in the S&P 500. An exchange traded note, which is a slight offshoot of an exchange traded fund, they trade the same. And in fact, I think there are a lot of people that maybe have traded an ETN that didn't even realize they traded an ETN. But I could create an exchange traded note that offers the returns of the S&P 500, but in a note structure, I don't have to own the shares of the underlying S&P 500. I still have to match the performance of it, and I might hedge myself somehow. But exchange traded notes are actually fixed income products or bond like products that give you returns based on some sort of strategy or some sort of index. There's a slight bit more risk in an exchange traded note. If you happen to, and I believe that there were some exchange traded notes that Lehman Brothers had issued back in 2008. They were fairly small. They didn't have whole lot of capital in them, not a lot of assets under management, but they did go the way of the dodo. They did basically go belly up with Lehman Brothers going out of business. And that's because the ETN was backed by much like any other Lehman Brothers bond. It just gave you returns that were the equivalent of different type of strategies or different types of exposures. So,
Sure. Thank you.
no problem. So, nice curveball question to start. Option pricing models, they do if you're taking derivatives and you're in the first session of options, you're going to learn about the Black-Scholes model. There are so many ways to get the Black-Scholes answer. Anybody that has a brokerage account can likely put in information. There are lots of free Black-Scholes calculators on the internet. I have an Excel spreadsheet that I use to do it. But these are the inputs that you would use to try to figure out what you think the value of an option should be. And notice I'm saying value of the option should be. And this is just an example. I got a stock trading at 50. We're talking about the 50 strike call. So got the strike price using a risk-free rate of 1%. And this day and age, I probably should raise that a bit. And we're saying there's 60 days left to expiration. And we are pricing, we are using implied volatility as an input. Now, implied volatility is not necessarily known by the marketplace. It's actually a market projection. And we use it to come up with a theoretical option price. In reality, the implied volatility and the option price are joined at the hip. And they basically, if implied volatility goes up, you would expect the option premium to go up. If implied volatility goes down, you would expect the option premium to go down. And the way we get implied volatility quotes on our trading screen is based on what the market price of the option is. So in reality, I'm going to go right here. Notice that said theoretical model. market model. And in this case, I'm using the options market price to calculate the implied volatility. And I changed the market price a little bit. Notice it was $2 on the previous slide, and now it's $2.50. On the previous slide, I had implied volatility, or an expected implied volatility of 20%. That was an assumption to come up with that $2 option price. In reality, the market is pricing in 25% implied volatility. So if I had sold this, let's just say both of these are market prices. If I had sold this option for $2 and went and got something to drink and came back and the stock was still at 50, et cetera, but the option price had gone up to 250, we would attribute that to an increase in implied volatility. So
So what
there we go.
I'm really seeing is that there's a direct relationship between price and implied volatility. So if
Exactly. And
price
when
goes up,
the,
implied vol goes up as well. Go on.
yeah,
Sorry.
no, that's okay. And in fact, the market makers and most market making pricing is being done electronically, but market makers, if they're seeing more buying than selling in their option series, I'm the IBM option market maker, and I want to see a kind of a balance between buying and selling coming in from the public. If I'm seeing more buy orders than sell orders, or more buying pressure than selling pressure, I would raise my implied volatility input to take the price of my options up and try to attract some sellers.
Mm.
Conversely, if I'm seeing more selling pressure than buying pressure, and I want to be as market neutral as possible and be as balanced as possible, I would take my implied volatility input down, and that would take the strip of options that take those prices down as well. Yeah.
So, and this is potentially a curveball question. One of the things that I looked at, and this has got to be back in 2008, 2010, is this idea that different brokers would have different prices at the end of the day. And when I spoke to these different brokers, part of the reason what they were saying is they might have too many buy orders or too many sell orders. Do
Mm-hmm.
you think as a result that not at the beginning of the day, but at the end of the day, there's a bit of an inefficiency then amongst the
Oh,
different brokers?
absolutely, absolutely. In fact, I often say that when I talk about trading an option, I often say that if you want to buy, you need to you can take the midpoint of the bid ask spread. And if you pay a little bit more than that midpoint, or you try to sell a little bit below that midpoint, you're probably going to get filled. But the market makers really don't want to sell below what they think the fair value is, or buy above what the fair value is, unless we're at the end of a trading day and they're a bit concerned about overnight risk. And where we really see that play out a bit is Friday afternoons. You'll see
Oh,
some inefficiencies on Friday afternoons in the SPX pit. You've got traders that just want to make sure if anything happens over the weekend and we have a big outlier move, that it doesn't hurt their positions too much, and they may be willing to take a small loss relative to the bid ask spread if it helps flatten out their exposure, or reduce their exposure to large market moves over the weekend. So yeah, the end of the trading day, in the beginning of the trading day and the end of the trading day, for different reasons, there's a lot less efficiency, and it's a better time to possibly get executed on a trade where you're not giving up the edge to the market maker.
that was where I was going with the next
Yeah.
question.
So sorry.
Yeah, no, that's great. Yeah, you were
Cool.
thinking exactly like, how do
So
you manage of it? Sorry.
you can take it. You can take advantage of that. In fact, a common acquaintance of ours has a systematic approach to doing that.
Oh,
It is end of the day trade, and I will leave it at that. So implied volatility, as we notice, they move up and down. Implied volatility moves up and down in line with option prices. VIX is based on S&P 500 index option pricing, and what is used is the expiration just before and just after a 30-day time frame. The result is this consistent 30-day implied volatility measure that takes basically all out of the money option contracts into consideration, as long as they have a bid and an offer. There's a little bit more to that, but for our purposes, that's by far the best way to understand how VIX is calculated. Uh, so, you know, it did not go forward. Go forward. So I know this is from a couple of years ago, but I really do like this chart just to show how VIX and the S&P 500 behave relative to each other. This is a nice inverse relationship between the two. You can see I really like this area here. We had the S&P 500 sell off and VIX pop up to these are the VIX levels, pop up to over 25. And then as the S&P 500 recovered, VIX started to go down. And you can actually see basically for this whole 6 months, they just kind of trended together. So this is a demonstration of the inverse relationship that I think most people are familiar with respect to VIX. Typically, if the S&P 500 sells off, if it's a big surprise, we can talk, and we'll look at this on charts in a little while. You get a big surprise like the reaction to the tariffs back in April. VIX can run up very, very quickly. In fact, I think that drop in the S&P 500 is maybe 5%, and the move in VIX is about 30 to 40% on that spike there. Yes.
So do the VIX and the S&P 500 always have this nice stance and this nice mirror image of each other?
No, they're actually the relationship, depending on the time frame, and this will come up in a minute, but depending on the time frame, the correlation between VIX and the S&P 500 is anywhere between minus zero point 0.7 to minus zero point 0.8. It really just depends on what's been going on within the marketplace. If it's a quieter time in the marketplace, believe it or not, it's actually higher because S&P will grind up a little bit and VIX will move down a bit. When we get in more volatile time periods, and there are times when VIX may go up when the S&P 500 is going up because people are worried that maybe we're going to see a drawdown at some point. They're historically, when the two trend together, that typically indicate, and what I mean by that is if both of them are going up, that means that there's a higher level of risk perception, and people are putting money to work to guard against a drop in the S&P 500, even though it's moving higher. I want to say 2018, we had about a 6-week period where they trended together. I was still at Cboe. We were fielding calls, is VIX broken? It's not doing what it's supposed to do, all this kind of stuff. And then we had the Russian debt crisis. And we had a big sell. So I pay very close attention to when they are trending together. And typically, if they're moving up together, that tends to indicate that there's starting to be some concern with respect to the equity market, even though it's moving higher. When VIX starts to move lower, even though the S&P 500 has made a low, that tends to, or is making new lows. That tends to indicate to me that traders are not as concerned about the direction of that the downside move in the S&P 500 is going to continue.
Yeah, so it almost sounds like that the market itself seems to have a deeper insight
Oh
than
yeah.
what we might be thinking about just in the general markets and in
Mhm.
general. Meaning that if you're reading this correctly, you might not know what exactly is coming up, like the Russian default, but you could be in a situation where you can say, okay, something's happening. And I
Mhm.
liked how you described that the market is putting money to work for downside protection. It's like proactive, and it's being
Mhm.
able to be, to some extent, the tea leaves of
Yeah.
saying, tea leaves of VIX saying something's going on. You might not be in the know, but something's going on.
Something's got much like a stock starting to creep higher, even though we don't have any news yet. Um,
Yes. And
So
and
we,
and I will like sorry to interrupt. And the negative zero point 0.7 to negative zero point 0.8, that's a
mhm,
strong
yeah,
inverse
yeah.
correlation.
And
That's great.
it, the math is not, I mean, although the numbers are going to match up with what I'm getting ready to say, about 1 in 5 trading days, they move in the same direction.
Mm.
A lot of
Okay.
people don't realize that, about 20%, but that even though it's a minus zero point 0.8, that doesn't, they don't relate to each other. But the
Right.
numbers kind of, for those of us that look at numbers and go, oh, okay, 100 minus 80 gives me 20. That has nothing to do with it. But about
Okay.
1 in 5 trading days, they do move in the same direction together. And so why is there this inverse correlation? And the reason is unique to index options on broad-based indexes like the S&P 500, where the most common use of of options in those markets is to protect against the downside, to the old insurance thing with respect to options. So, and we know this because I always love this put call ratio. This is a ratio of the put volume divided by the call volume on a daily basis from the beginning of 2022 through June 30th of 2025. And you can see we never fall below that red line. Now, it has fallen below that red line historically. There have been trading days every once in a while where more calls traded than puts, but typically, on average, about 1.5 or about 1.5 puts trade for each call on a trading day, and that is really associated with, I hate to use the phrase legitimate use, but legitimate use of put options. And then you can also see some spikes on there. And those spikes not only coincide with extra put trading, they tend to also coincide with a big move up in VIX. We see that as well.
So this
Yeah.
is great.
Mm-hmm.
And again, I know we've spoken on different videos about our backgrounds and where we're coming
Mm-hmm.
from in the derivatives market. Could we talk a little bit about how this relates to the volatility smirk or the volatility smile?
Oh,
Um,
absolutely.
because
Um,
I feel like that's a term that you're going to hear in your derivatives class, but it's so important to really understand the fact where the smile comes from a practitioner standpoint, and how this shows up, particularly in the VIX market. Ooh,
so
that's a nice smirk.
what Oh, thank you. So before, and I'm not gonna, I'm going to quit while I'm ahead because I don't usually don't do very well when I try to draw on a slide. But put implied volatility is, I'm going to say always because I never recall it not being, but out of the money put implied volatility is typically higher than out of the money call implied volatility for index options. This is not true for commodities. This is not true for individual stocks even. But so, right here, we might have implied vol. Let's say this is I'm marking a 5% out of the money call. Let's say it's got an implied volatility of 20. 5% out of the money put might be in the upper 20s. Those are just hypothetical numbers. But before the crash in 1987,
Mm,
puts and calls were priced the same, and it was a smile. And then after 1987, where a lot of people that were selling out of the money puts got run over, which
yeah.
means they were short those puts and the market went down faster than they could get out of their position. When that happened, we come back after a couple of days, everything settles down, the stock market starts to trade somewhat normally. One of the big changes after the crash of 87 was out of the money puts started to be priced with higher implied volatility than out of the money calls. And that's just because we had never had listed options where we had had a drawdown like we did in 87. I think the previous drawdown was 29. Um, so that's why the shape, when you draw a shape for S&P, this is S&P 500 option contracts. When you draw this out of the money puts are going to be more expensive than out of the money calls. Now I'm going to say something and you have to wait.
Okay.
It's opposite for VIX. We're going to talk about options. I know you're dying. You're just dying over there. Um, So it is opposite for VIX, out of the money VIX calls. And you can think about that one with respect to what we took a look at on the VIX chart. Here's the annual, and this is how I personally like to look at implied volatility for any market. Um, I feel like, if you didn't look at, and I'll bet a lot of people are just looking at the chart and not looking at the title of the chart. This is the high, low, and average for VIX each year from 2000 through, and the final bar on the far right is through June of 2025. And the little red diamonds are not the close. They are the average VIX for each year. We had an instance, I think it was 2016. We debated this when we were talking before we turned on the camera. I think it was in 2016 that, right, I have an eraser and I want my laser pen right here. I think that I believe it was 2016 or maybe the end of 2015. But one of those years, we closed on the high. We were approaching something called the fiscal cliff, where it looked like the government may shut down.
Oh, yeah,
And and because of that, there was a lot of uncertainty going into a long weekend for New Year's, and and VIX just kept grinding higher, and the VIX futures grinded higher as well, based on a big level of uncertainty over that weekend. They had a budget agreement, and VIX came right back down. The S&P 500 went right back up. But back to the average thing. The average gives you an idea as to what sort of volatility environment we've been in. We always like to define high volatility environments and low volatility environments. You can see, I'm going bonkers here. High, low, high, and we had low for a while. And then it's been debatable, to be honest with you. But we had these cycles, and this is one of those great past performance does not give you future performance. But when this happened in 2020, everybody felt like we were, and when I say everybody, I mean all the VIXophiles out there, felt like we were moving into a high volatility environment. Then we had 2021, 2022. We've kind of been in a transitory environment, I would like to say, for almost 6 years. In fact, I was at a conference in earlier this year, and I got to ask a question to the audience. The polling software crashed. So I made up a question, and I said, are we in a low volatility regime, high volatility regime, or transitional? And like 80% of people said transitional. And then are we transitioning to high or are we transitioning to low? And everybody thought we were transitioning to high. And lo and behold, this was back in February. Lo and behold, we've gotten an average VIX above 20 since then. So we'll see if that holds. As you and I sit here, VIX is around 17. So maybe VIX has reached a point where we don't go through periods of an average high or an average low, that it's more reactionary to what's going on in the stock market. But I've always liked to use an average of 16 as the high low to define a high regime or a low regime. Most people like to use 20. I like 16 because 16 indicates that the expectation is a one standard deviation move. Each day is 1%. And I feel like 1% is significant.
Yeah,
that's my thinking.
I would agree with you on that. And it's interesting when you're looking at this and you think about the different presidencies that have come through. And you can think about, okay, because we started in 2000, that's when George Bush came in. And it's interesting to think about the events. And one of the things I did want to ask you was, with all of this reactionary, what is really considered a volatility event?
I think a volatility event is something that pushes VIX above 30 very quickly.
Okay.
And I use that phrase. That phrase goes back to working in an exchange where you have to soften some of the language that you use. but a quick sell-off in the equity market is something that I refer to as a volatility event. I did want to mention a small warning here. This is, and I'm going to see if you know the answer to this question since you've been asking all the questions. You can see that we've gotten in 2020, we surpassed, and these are closing highs. I use daily closing data. So you can see in 2008, we hit, I'm going back to the highlighter, and I want to change the color of the highlighter. So you can see here we went above 80, and here we went above 80. Great financial crisis, COVID. Do you know what level there is there's a precursor to VIX called VXO. It's based on the OEX or the S&P 100 index options, and Cboe backdated it to 1986. Do you know how high it got in the crash of 87?
I don't know, but I'm so curious. What is it?
150.
Holy smokes.
Yes.
Sorry.
So, and the point behind that is you see people selling 100 strike VIX calls. They're not
Wow.
taking a lot of money for them, but you see trading with strike prices above what you're looking at on this graphic. And part of it, they're usually matching them with some other trade. Maybe they bought a 40 call and they're like, well, it's never going to get up to 100. Let's lower the price a bit or something like that. But just because you see this, I don't want somebody to go away and think that VIX will never go much above 80 or stay. The backdated using S&P 100 index options back in October of 1987. The VXO is the ticker for it. I think they still update it, but VXO, you can get the history on that. It's high as a little bit above 150, if I remember correctly. So just wanted that's kind of a warning. And part of what I try to do when I talk about VIX is make sure people don't do silly things. And I'll bring up a couple of more silly things shortly.
Oh,
So,
wait. I want to go back to the so I didn't live through, I mean, I was alive in 1987, but
mhm,
I wasn't active in the markets in 1987. But I've spoken with enough people who have lived
mhm,
through that. And I think and I'm bringing it up because I think it's important to really understand the history of the markets because there are
mhm,
people who are still active in the markets who remember that and who lived through the day and participated. I think your explanation of the out of the money puts really, because that was one of the big strategies of the time, and
mhm.
a lot of people had that strategy and they all unwound at the same time. But from what I understand, and please correct me if I'm wrong, that day was uh, catastrophic.
It was, there were, and actually you're going to be, you're tomorrow, you're going to be talking to somebody that was in the OEX pit during all of that. So you can ask him questions about it if you really want to.
I, I'm curious
But
because
my
it was
understanding is everything was running 2 to 3 hours behind because everything was manual back then.
sure.
Like you didn't really know where you were getting the way that people would trade back then. Somebody would yell something out. I'd write something on a ticket. You'd write something on a ticket, and they get matched up somewhere and sent out on a system. And we would see the price. The price reporting was falling way behind because it just couldn't keep up with everything.
Yeah, I had a friend who worked at Salmon at the time, and he was commenting that every time you'd come up to the quote machine, and this is when people smoked in the office, and just the amount of smoking that was happening, and
Yeah.
the intensity because everybody's glued to this machine waiting for that updated price. And
And
again, I'm only taking a small deviation in this because to your point of we've seen, and in my experience, the 2008 crash was unbelievable, but
mhm.
1987 wasn't that much longer. Like
No, it
it
wasn't.
we're not talking 100 years ago. Um, And this idea that these things can happen and they can be much more catastrophic than even in 2008, even in 2020.
Yeah, I worked at I was bartending at a place that was owned by a handful of brokers in Memphis.
Mm.
And so we had all the TVs on the business networks, and that's the closest I was to experiencing it. I actually thought they may have to close the restaurant. I was actually in a roundabout way worried about my job, even though I was only 20. So,
Sure.
so
Yeah,
there,
because it was just it at the time, you're just, oh my goodness.
yeah. So
Okay.
as I noticed, just to wrap up on the index and get into trading it or trading things associated with it, you can't trade spot VIX. With few exceptions, SPX puts do drive the implied volatility of S&P 500 index of the whole complex of S&P 500 index options, and they have the put options do have more of an influence on VIX than call options. That's where we get that inverse related relationship from. And when VIX is going up, when VIX is at higher levels, that just means that portfolio protection has become much more expensive. People are less willing to sell insurance, much like after the crash of 87, guys in the pit didn't want to sell insurance unless they were getting compensated a bit more for it than they did in the past. And that's kind of funny because the crash of 2008 was basically caused by people selling insurance on mortgage bonds. To find the next crash, we got to be
Yes,
looking for something like that.
gotta
So
find more insurance products that are mismatched in price.
yeah. So VIX futures, if you take $1,000 and multiply it by the level of VIX, that gives you the notional value of the contract. They trade in increments of 5 cents. If you are trading a calendar spread, and a calendar spread might involve selling the July contract and buying the August contract, the spread is only a penny for that. I did do some work with a proprietary trading firm in Europe that does nothing but trade calendar spread or trade different types of calendar spreads. And and they day trade them. One of the reasons they're able to day trade is if you've got that relatively small tick. The
Oh,
standard contracts are well over 95% of the volume. There are weekly futures available for trading, but the volume there are days that they don't trade at all. So you really want to pay attention to the monthly futures contracts. Those monthly futures contracts, they do start trading just like S&P 500 futures. They trade 24/5, and based on where we are within the expiration calendar, typically you would expect both VIX futures and options to settle in the morning on a Wednesday. So VIX settlement is on a Wednesday before the market opens, which are you aware of why?
I was just gonna say, what? That just doesn't
So
make sense.
VIX is a measure of 30-day expected volatility based on options that expire just before 30 days and just after 30 days. Well, the standard VIX futures are the contract that will be right at 30 days when they expire are the standard old school third Friday AM settled SPX options. So if you take VIX expiration and you add 30 days to it, you're going to get the third Friday of the next month. And the VIX settlement is based on a special opening rotation to get as many traded prices as possible for VIX. And it uses one series, again, and it uses the series that expires 30 days in the future on Friday in the morning. Now, if we have a Friday holiday, which happens, we
We just had
typically
one.
it's a good Friday, but typically every third or fourth year we have a Friday holiday. So standard third Friday options would expire on Thursday, and we would have VIX settlement on a Tuesday morning. I did have an instance once where I had a position and I didn't realize that it expired on a Tuesday morning instead of a Wednesday morning. It didn't hurt me or anything like that. I was just kind of surprised to see that it wasn't moving. It wasn't moving because it had already settled. But again, typically They occur on a Wednesday and they are AM settled. Now, we mentioned at the beginning that things are very unique in the volatility space. And one of the things that you learn all about when you take derivatives is the fair value relationship. You can, if the S&P 500 is at a certain level and I'm doing down here and the futures are up here, you can short the futures, buy the S&P. If they come back in line with each other, you can get out of that trade. They don't trade right in line with each other. There's time value of money, dividends, and other things associated with that. But what that does is it makes the S&P 500 future basically track the index during the trading day. You can't trade spot VIX. Therefore, VIX futures can trade at a premium. They can trade at a discount. The relationship is there because VIX futures do settle into a VIX calculation. But when there are months left to expiration, you don't really see the VIX future react to moves in the underlying index. And that's because you don't have traders shorting spot VIX and buying the futures or selling the futures and buying spot VIX when they get out of line with each other.
I have lots of questions for this
I
slide.
know you do.
And
That's my drink.
let me see if I can understand this correctly. And if I can talk through it and you can tell me where I'm wrong or, yeah, you're headed in the right way.
Uh-huh.
The fair value relationship, you are trying to say that in other products, not VIX, correct me if I'm wrong here,
Mm-hmm.
that the fair value between the future and the underlying should be in line with each other. Is that correct? Am
Yes.
I understanding
They're
that?
basically they should follow each other through the trading day. Normally I'm saying price like that. I'm doing this. So this would be the how do I do this? This would be the S&P 500, and this might be the futures relative to where relative to mathematically they should be trading in line with the index. And as long as the S&P 500 futures can't be bought or sold in conjunction with doing an offsetting position in the S&P 500 and lock in some sort of arbitrage profit that is above a risk-free rate, a trade presents itself. Because those trades present themselves when the futures go up, and let's just say big order comes in, buys the futures, pushes them up here, the arbitrage firms will buy stocks and sell futures. In fact, back in the day, you would periodically hear people on the floor say that a buy program had kicked in or a sell program. Well, a buy program would be when the S&P 500 futures had gone up, and now people were buying stocks and shorting the futures, so the S&P 500 was moving up. And I think they tried to attribute that to some sort of an artificial move, but it's a market move and something that should be paid attention to.
Right. And so
Mm.
you're saying in the VIX environment that this doesn't hold to be true. And it's
Not at
because
all.
you can't buy and sell the underlying.
You cannot replicate, and I'll give you the company line that I used to use. It is operationally difficult and prohibitively costly to replicate spot VIX in a portfolio. We mentioned that you're using two different expiration series. Well, the time balance of those two changes every minute during the trading day. We only use out of the money option S&P 500 options to calculate VIX. If the S&P 500 moves 20 or 30 points, you've just crossed 5 or 6 strike prices. So, and then finally, VIX is calculated using the midpoint of the bid-ask spread on the options, the relevant options. Try to trade a whole strip of options at the midpoint and see what happens. You're not going to get executed. If you put in a big buy order, basically all the offer prices are going to go up because or maybe people are going to join you at the bid. I don't know, but you're not going to get executed and be able to replicate VIX. So, and some very smart firms in Chicago back when I worked at the exchange would invite me in to talk to them about VIX. And they were trying to figure out how to replicate spot VIX.
Sure.
You could
Because if you
tell
can,
by what they were. You could tell by what they were asking me. It was often a very one-way conversation, which is typical of prop trading firms. I don't. I think if somebody had figured out how to do it, it would show up in market pricing. If I figured out how to do it, I would do it really small so that nobody else knows that I'd figured it out. Or I'd sell it to a big firm and go live on an island. So,
And it's interesting you talk about like the out of the money puts and options. Oh no, we have to go back. There's more questions I
oh,
have.
I'm
Oh,
sorry.
sorry,
Going to use
we're
this as an
not
example.
done. Um,
Okay.
one of the things that there's a academic paper about the carry trade, and it said,
Mm,
you know, buy options that deep out of the money options, maybe two standard deviations away, that you could optimally hedge that your portfolio. And I remember talking to some practitioners, and they almost laughed in my face and said, well, if you bought those options, you've moved the market and they're no longer uh, priced at a way that you would want to hedge it. And you've
yeah.
just eroded all your losses. And so I was kind of entertained by, I didn't write the paper, so I was entertained by the fact that, you know, you can think about some of these things, but putting them
Hmm.
practically isn't going to work. So I
Yeah.
go ahead.
Academics don't think about liquidity.
No, no, and it's never something.
No.
And one of the reasons why I think it is liquidity is hard to measure.
Hmm.
Like,
Yeah.
how do you actually
Yeah.
price in liquidity?
Yeah,
Uh,
we were talking about somebody that does a really good podcast earlier, and I was listening to him on the drive back from Indiana yesterday, and somebody was talking about a model they had that had a Sharp of, I don't know, 2.6, 2.7, something like that. Uh, it had really nice risk adjusted returns, and the host said, "Well, that's your model. When you implement this in the real world, what do you think you're going to do sharp wise?" And I think the adjustment might have been to the low twos or something like that. But
mhm.
whenever I test something, I incorporate a lot of slippage. I just
Yep.
automatically assume that when I do a trade, the market's going to change based on that trade.
Yeah, yeah. If especially if you want to have a good projection of what your real returns are going to be,
Mhm.
as opposed to this perfect environment that you've created where we've optimized all the right ratios and
Mhm.
it's not going to be. So I
No,
think that's an important point. Um, and I have to ask, can you explain contango and backwardation?
backwardation, Contango.
Okay, great. Woohoo!
I'm gonna explain a little bit more than that.
Okay, good.
So as we noted, the VIX and the associated futures do not trade in line with each other. And one way that we like to look at the overall volatility market, and I do feel like if you're looking at VIX as an indicator, you need to look at the futures as well. Uh, what we like to look at is where is the index relative to the futures contracts. This is right around all the tariff announcements. VIX ran up to the low 50s. The April contract, which had about a week left before expiration, stayed below 40. Uh, as we go farther out, the expectation is that VIX is going to come down. I just to show why people feel like that. VIX goes up, it comes down. VIX goes up, it comes down. So those futures are pricing in that reversion to the mean that VIX does price behavior wise. Everybody is familiar with that. This is really interesting with spot VIX at four, or with spot VIX in the low 50s. And there was only about a week left before this April contract uh, expired. So the April futures are anticipating VIX is going to come back down by 12 points or so over the next week. What does it take for VIX to go down?
The
This is where
market, the market to go up.
exactly. You can use the futures versus the spot as an indicator.
Okay.
When we're in back, we don't stay in backwardation very long. Now, we have had periods where we have been in backwardation for 2 or 3 months, and that's during periods of very high volatility. But typically, there are only about a dozen 20 plus day periods, if memory serves me right, where we were in backwardation on a consistent basis. I think we had a long streak of that in 2022 as well, and maybe this year. I've got to check my numbers on it, but you can see the feeling is and you and I are speaking now. July is the front month contract. July was around 27. VIX is at 17, and needless to say, the stock market's up 20% since this day here. That doesn't mean buy the stock market the second that we go into backwardation. We can stay in backwardation for a while. Um, but this gives you an idea that people who actually put money to work in the volatility space, because this is based on putting money to work, that's based on S&P 500 index option pricing. The feeling is it's going to come down. Typically, this is what the VIX term structure looks like. And this is Contango. The other one was backwardation. This is as of June 30th. We've had a nice rally in the overall stock market, and spot VIX has come down from the 50s to below 17. You can see the July contract, which had 3 weeks to go on this date, set about a 2-point premium relative to spot VIX. And and the other futures are at a pretty good premium as well. In fact, this was the widest premium of a front month future relative to spot VIX in 2025. And much like, not necessarily in the exact same method where you could take this as the anticipation that this is going to come down, but if you're short this future, you want to be compensated for taking on the risk of being short something that can double in a day. And the way that you get compensated for that is the spread between the spot index and the futures contract. So you can take that as, and with everything that's going on in the world, and we're in early July of 2025. You could take this as the stock market's doing fairly well, but we're a little concerned that something might come out news-wise that causes a short-term volatility event. And I think a lot of people like to talk about the president's tweets. I think a better, more professional term to use is headline risk. And if we've got risk that Iran actually, we didn't hurt them at all, and they've got a nuke now, or just my silly example in ballrooms from 5 years ago used to be, if you've got a friend at the Kremlin and Vladimir Putin's gonna invade a neighbor, maybe you want to buy that July future. Maybe, but that's an example of headline risk. I got to come up with a new silly hypothetical. I guess no hypothetical
wasn't so silly.
No, it was not. But I feel like that's how you can, and that's part of what I do looking at the volatility term structures. I really try to interpret what it's telling us. And with that lack of fair value and just money being put to work based on where you think volatility expectations are going to be, not necessarily where they are right now. There's a lot of information in VIX futures. I tell traders, if you put VIX next to the S&P 500 on your trading screen just to kind of get a handle on what they like to call as the fear index relative to what the S&P 500 is doing, you're really doing yourself a disservice if you don't put the first 2 month futures in there as well.
Sure.
Because there's information in that. If VIX were going up, the day after this chart here, and the July future were coming down, you might actually take that as a signal that even though VIX is going up a bit, that traders that put money to work feel like that's a short-lived move. VIX will probably go back down, and it's once again bullish for stocks.
And I think that comes back to your headline risk, right?
Mm-hmm.
Because especially since we've had a lot of headline risk.
Well, yeah.
We've had a lot of things that have come out, and it seems like something dramatic is going to happen, and then it's weirdly taken back.
And that's the one thing that I find unusual about this spread right here. It seems like headline risk is being priced in, even though the headlines don't ever really cause price. We ignore them. After it's the boy who cried wolf. That was the story I'm trying to think of.
Yeah.
Eventually we're and I've had this attitude whenever People ask me what I think, what the impact's going to be, and what is DC actually going to do. I'm just going to wait and see what actually happens. I've kind of scaled down trading wise, et cetera, and just waiting to see what the actual outcomes are as opposed to what's being said. Because saying and doing seem to be two very different things in this day and age.
Well, and it's interesting you bring that up. Before President Trump took office, the big debate or discussion was the Fed going to do in reaction? And the consensus at the time was, well, we have to wait and see what President Trump is going to do.
And just, yeah.
And it was just this very much wait and see. And that's very similar to what you're echoing again of, if nothing else, since he's taken office, even more wait and see what actually transpires.
And it does seem to continue to get pushed out.
Yes.
Yeah. So there. So this, I know this is an old chart, but this really is one of my favorite charts to demonstrate how VIX futures and why you should be in the front month VIX future if you think there's going to be a volatility event or a spike in volatility. I like this chart. It's the last 3 months of life for the December of 2015 contract. You can see they converged at the very end. Not only did they converge at the very end, but like the last 3 weeks, the December future basically tracked spot VIX. But what's really funny is when we got these days here in spot VIX, and the future kind of held up, didn't follow it down. Kind of an indication that we think we're gonna bounce back up. We're not following that dip down or that dip down, et cetera. So it just a few interesting, but I like that. I like that it doesn't follow here because there's 3 months to go, but it totally tracks here because there's 2 days to go. And finally, I like this one because spot VIX started and ended at the same spot, whereas the December future started about 2 points lower than where both of them were on settlement date. It's just we also ran this at Cboe, and what we showed was the beta of the front month future relative to spot VIX, and then we pushed the beta out farther. And the closer we get to expiration, the higher the beta for a VIX future. If you want exposure to volatility and you think there's going to be a volatility spike, regardless of the time frame, you want to use the nearest dated VIX future.
So I have to ask you to explain what beta is in how you're.
Beta is how closely one market tracks another. If you've got an old school S&P 500 stock that kind of moves in line with the S&P 500, we say that stock has a beta of 1.
Right.
But you could also just say it's the correlation.
Sure.
And we did it by, I think, going all the way back to 60 days. Like all the 60-day futures over 20 years, how did they do it? It was a fun exercise, and it got up to about 0.85 or so when you got very close to expiration.
So which is pretty amazing, right?
Yeah. So right there, that's a clear indication that the December future doesn't have much of a beta at that time with spot VIX, especially with spikes. So there are strategies. I'm going to run through this one somewhat quickly because volatility is a tradable asset. And this goes beyond VIX, but you can see that shorting volatility, if you're in a short volatility hedge fund, you tend to grind out, get hit, grind out. This is just very typical of a consistent short volatility strategy. Consistent short option strategy would look like this as well. Thank you very much, COVID. Up. There are several things on this chart. One is that quick recovery in COVID. That really is a function, I think, of investors understanding that you're going to have drawdowns in short volatility strategies. And if anything, you don't want to bail out on weakness. You probably want to add to your positions on weakness. And I know some managers who said that they had net inflows after the big drawdown in volatility around COVID. Um, again, this is all volatility, all types of short volatility, long volatility, lots of breakouts here, et cetera. And then the market started to get a bit more mature with respect to volatility. You've got this really nice move here, which is opposite of what happened for our short volatility. Relative value, and that line is really straight. I'm gonna have to check those numbers. But so relative value volatility, this is where some skill is involved. You'll have volatility, I don't want to say investors, volatility traders who will try to find options that they find to be overvalued and options that they find to be undervalued based on an implied volatility. Where do they think it should be priced? And this is much like thinking that Coca-Cola is expensive relative to Pepsi. You'd buy shares of Pepsi and you'd sell short shares of Coca-Cola. If options and the way that I trade relative value volatility, I actually trade it with Russell 2000, S&P 500, and NASDAQ options. And I use daily options. So I'll buy some and I'll sell some based on where they are priced relative to recent history, et cetera. But relative value volatility hedge funds, they do quite well. They don't, they'll pump out pretty consistent returns and with very low volatility on the returns. There are periods where you're not making much at all. I think from 2017 through almost 2022, most relative volatility hedge funds just basically broke even. They fell out of favor for a while. Apparently, they're coming back in favor now. And then finally, with respect to strategies that take volatility into account, tail risk it involves, if you think about consistently buying 20% out of the money S&P 500 index options, they're going to pay off twice on this chart. 2020 and 2000, and actually 2020, this is 2008, that's 2011. But tail hedges, you expect to lose money on a tail hedge.
You should.
CalPERS. Yeah. Did you know about CalPERS and tail hedge?
I don't. No.
Oh, CalPERS, and I'm not sure which bike on here, but the board of CalPERS told it, and CalPERS is the teachers' retirement out in California. It's one of the largest, multi-strategy investors in the world. They took all of their money out of tail hedges right before one of these spikes, and I really do think it's this one back here. Why are we doing this? We never make money on that asset class. Stop doing it. And they stopped putting money into a tail hedge, and lo and behold, tail hedge funds on average were up 30% in a very short period of time. This also shows what you should do if you make money on something that requires high volatility to pay off. You monetize that thing. You don't, if you had a tail hedge and you just left it alone, well, it takes maybe just a few months for you to have given all of that up. So tail hedges, you do want to monetize them, and your manager should have rules in place where they monetize a tail hedge on your behalf. And typically managers will give up maybe 50 basis points, 100 basis points over the course of a year to have these positions in place. Yes, on the front row.
Yes. Quick question. What is tail risk?
Tail risk is risk that you're going to have a huge outlier move to the downside.
Okay.
It's defined. Let's see if I can draw again. This is going to be a tough one. Oh, if I do this, I'm going to be so. Look at that.
I know what that is. You did
down there.
Yep.
There you go. That's a bell curve. It's like a 2 or 3 standard deviation move to the downside.
And
That's what you're hedging against. And this isn't going to pay off if you have a one standard deviation move to the downside. It's only going to pay off. I probably should have made the circle more like that. So that's what a tail hedge is. You're worried about it, and it's like catastrophe insurance. I'd
and
almost say it's like homeowners insurance. You really, you don't pay a huge percentage on the value of your home, but it will reimburse you if your house burns down, which is a tail event.
yeah, and I think tail events, or at least the discussion in graduate classes, were much more prominent back in December of 2007, even a little bit earlier than that. And I think
Yeah.
it's gone out of vogue in curriculum. However, to put things in perspective, I think the 2008 crash was considered a 12 standard deviation move. Please don't.
In certain markets it was.
Yeah, and
Yeah,
but to
it
put things
was.
in perspective of when and why this type of product is valuable, because if something like that hits, and if this is going to protect you against a two standard deviation move, you
Mm-hmm.
can have, particularly in the financial markets, these huge outlier events because we have what are called fatter tails.
Mm-hmm.
And so tail risk is actually something very real, and something, especially if you're a larger portfolio like
Mm-hmm.
CalPERS, where you have multi asset classes and multi strategy, this is something
Yeah.
you should be very aware of and very willing to protect against.
And the real selling point behind having guarding its tail risk, what kind of return do you need to make if you just lost 50%?
Right.
It's a
Yeah,
hundred. It's
right.
100. I heard somebody being tricky lately. They said if you lose a fifth of your portfolio, you've got to make a quarter back. Like they were saying 20% and 25%. But
Right.
recovering from losses,
Ooh,
it's if you're down 30% here, you've got to this is opposite of that. But if you're down 30% there, you got to make more than 30% to make it back.
right.
So and then the other thing with respect to an entity like CalPERS, they're paying out money every month,
Yes.
and they
Yes, they
need
are.
to perform to keep up with that. So they're managing against liabilities, and we get some sort of a market crash. They may have a shortfall relative to their liabilities.
And just a quick comment on that.
Mm-hmm.
The reason why CalPERS does have that payout is they have pensions that they need to pay out to retired teachers.
Mm-hmm.
And because we've moved away from a pension system, but for those
Mm-hmm.
still have pensions, just so that everybody's aware, you want to make sure that your pension is funded and that it's capable of
Mm-hmm.
meeting those requirements. And so, to your point about CalPERS, if for some reason they have a major downside loss and they don't have the extra funding to pay out for that pension, those
Mm-hmm.
retired teachers could be in a very bad situation where they're
Oh,
not able.
absolutely.
And that's
Absolutely.
a reality of being a portfolio manager for a firm like CalPERS.
And I saw the manager of a CalPERS present at a CFA conference a while back, and I've forgotten what the number was, but there's a large number of teacher retirees in the state of California over the age of 100. They have
Wow.
been paid. Yeah, it's they
Sorry.
yeah. But I mean, and it's just one of those things that it's not overly shocking if you think about it. It's a state, where everybody's kind of healthy. Um, you know, if you retired at 65 or so and you're able to live a very healthy lifestyle and get outside every day, maybe you do live to 100. Sounds painful to me, but that's okay. So you can see the tail hedge just intra. Yeah, and I indexed all of these strategies. This is for 2020. The tail hedge was up almost 60% at one point during the year. Long volatility was up a bit, then both of them started to tail off. Relative value grinded out a return. I do think I'm really impressed that short volatility was up in 2020.
Mm.
That's absolutely, I mean, not all managers were, but on average, according to
Yep.
the short volatility hedge fund index, they were. So VIX options are index options. They are cash settled and they share an expiration date and an expiration value with VIX futures. Um, VIX option pricing looks wrong. If you ever see an option price that looks wrong, you think you found an arbitrage, do not trade it.
Okay.
I don't know how else to say it. They don't pop up, and
Warning,
we
warning.
I've had too many people that made mistakes in VIX, like I'm getting ready to talk about, because the options look like they're giving you. I don't want to say free money, but an incredible edge relative to what's going on in the markets. And the best thing to do with VIX options, and again, I know this is an old example, but I like this example an awful lot. I also traded it, so I can talk about it. Um, Typically, when you're looking at an at the money call and an at the money put, the price of the at the money call and the at the money put are going to be about the same. Yeah, there might be a slight difference based on time value of money, et cetera. But with VIX is at 1150, and you've got the 12 strike put at 15 cents by 20 cents. You've got the 12 strike call at 310 by 330. This is not the kind of pricing that you would expect for an at the money option. This is. These are September options, and they are for in reality, there's a small disconnect here. But for traders like us that are just trading through a retail brokerage account, the best underlying security to price a VIX option is the corresponding VIX future. And in this case, the September VIX future was at 15. Now, the cool thing is if you think VIX is going to stay at 1150, you can buy some puts that would do quite well based on that 1150. We're going to take look at some choices in here. So let's say we expect VIX to remain at 1150. As I mentioned, it traded it. It did not. But that's what we expect. What I've put in here is what is the break even for buying each of these puts? The assumption is you would hold these into cash settlement, which means whatever the settlement value of VIX is relative to the put would pay you out. If I were to buy the 12 put and VIX settlement is 1150, the option is worth 50 cents. My profit would be 30 cents. So notice on all of these, if VIX doesn't move at all and we buy these options, I'm using the ask price, you would actually make a profit. And for no other reason other than illustration purposes, I'm choosing the 14 puts. If we buy, and also because I traded it, if we bought the September 14 puts for $1.05, here's what the payoff looks like. And I'm including where spot VIX is and where the September future is. If I didn't have spot VIX on here, this would look like a very normal payoff diagram relative to a market trading at 15.
Right.
But in reality, we're being priced off of this. We're going to settle based on a VIX calculation. We settled somewhere in this 12 to 13 range. So I did make a small profit off of it. But I also had a cushion to be wrong.
Right.
And we talked about short volatility being a pretty consistent strategy. This is a risk controlled method of being short volatility. What happens to me if Vladimir Putin decides to invade a neighbor and VIX goes to 50 and I have bought this put option? I lose what I paid for it. Mm-hmm. If I shorted that September future, I might end up in a situation that looks like, where's that? I don't want that. Nobody wants that. I guess if you own it, you want that. But if you're short it, and that is an issue with being short volatility, is typically you've got a lot of risk if things don't go your way. I like to buy puts on VIX when situations like this present themselves. and take advantage of that buffer that you have in there. And typically, if you find trades like this, the win rate's around 70, 80% or so. It's they work out particularly well if you trade them close to expiration like that.
Which is 70, 80%. Again, and I'm thinking about this for a number one fan. That's
Uh,
high.
yeah, that's really high. But and
That's
the problem is you know I'll the trade that I did like this recently, the option cost about $2, and I ended up making about 40 cents off of it. So when you do lose, if you lose the whole premium, it usually is 2 or 3 times the profits that you're realizing on the trades as well. The opposite side of this is puts are really cheap to the point of not even having negative time value relative to the index. Calls are expensive. I mean, calls are already have much higher implied volatility. I mentioned on the when we were talking about the skew with SPX that out of the money puts are more expensive than out of the money calls. For VIX, out of the money calls have higher implied volatility than out of the money puts, and we do calculate that based on this, on the future, not on the index. But so we've got high implied volatility on the call side, and we got an index that's at a $3.50 discount to the future contract. You got to have a lot of things go right for you to make a profit on this trade. And I mean, the break even would involve VIX going from 1150. Let's just say we wanted to hold it to expiration to 1825. I mean, that's a ridiculous. I mean, VIX can do it, but it doesn't do things like that very often. So one of my mentors, one of the best people ever, this gentleman named Marty Kearney, had a saying that I love to steal. He would say, if you've got to buy an expensive option, look at selling expensive options. And that's what we're going to do right here. We're going to take a look at, maybe we just think this, if we get a volatility event, it's going to run up above 20. Well, we can do this trade. Now we've got 45 cents of downside. It's cheaper. We're sacrificing some upside. And our break even has come down a bit. The next trade I'm going to show you is actually one of the most popular trades in the VIX pit.
I'm very excited.
You're going to sell that put, that 13 strike put for 45 cents. And the net result here is no cost, zero cost. And this is our payoff. Our payoff above 17. We can make up to 3 points if we're above 20. Our risk is that VIX remains at relatively low levels. What needs to happen to keep VIX down here and make the future come down here in the stock market? Stock prices need to go higher. Mm-hmm. This trade is often matched up with equity portfolios because if the stock market rallies strongly and VIX remains at relatively low levels, you are going to lose money on this trade, but you would make it up in your equity portfolio and maybe then some. But and I think that's one of the reasons this trade is fairly popular. VIX has not gone much below 9. So there's not this risk that VIX is going to go. If VIX goes to 0, I doubt anybody's going to watch this video, but we'll have a lot of other things. You know, VIX goes to 0, that means that like an EMP has gone off over North America and we're done. I mean,
it would be very difficult.
Basically, the market's closed. Yeah. So but this is a very popular hedging transaction. And I'm on a podcast where I talk about VIX every week, and I look at large trades, and I see these pretty frequently. Ooh, where are we going here? So the third way to get exposure to VIX, and it's not exposure to spot VIX. VXX, not, SPY gives you direct exposure to S&P 500 performance. VXX gives you exposure to the front 2-month VIX futures contracts, which are more often than not priced higher than the index and are grinding lower every day. If you, I know I keep doing this, and this is the biggest complaint I get from students as well, is that I pop around too much. But if you own VXX and spot VIX doesn't move at all one day, or even if it ticks up a little bit, there's a good chance that future's going to go down. That future's going to go down, but also that VXX is targeting like a 30-day time frame or a balanced time frame between these two. It's selling the front month future and buying the second month future. So VXX has what they refer to in the prospectus as a negative roll yield. And that negative roll yield causes a lot of pressure on VXX. And we'll see that in another one of my old but favorite charts. So VIX exchange traded products, the exchange traded notes, and the exchange traded funds are not direct investments in VIX. If they are, we would trade VXX against the VIX futures.
So I have to ask, what is a roll yield? And
the roll yield, rolling in general, that involves buying one future and selling another just to move your weighting along. With the VIX exchange traded products, the ones that we consider short term, and this short term focuses on the front 2-month VIX futures. Every day they will sell some of the front month and buy some of the second month. And because the VIX term structure is in Contango about 80% of the time, they refer to that as having a negative roll yield to maintain that front 2-month exposure. So there are days that VIX goes up a little bit, but because of the negative roll yield, VXX might go down. There are a handful of these exchange traded funds and exchange traded notes available. VXX, it holds the front 2-month VIX futures and has a 30-day outlook. And those trading costs are what caused the drag. I did want to take a look at, yeah, there it is. So this is another chart with VIX versus, and in this case, versus VXX. And VXX, it actually reverse split. So it didn't even start the year at 110. But when we change it for the split, it went from 110 to 20. VIX went from 19 to 18. I don't know how else to say VXX is not direct VIX. However, there are short versions of VXX. And over long period, they do have drawdowns, but over long periods of time, those short versions tend to do fairly well. This is a list of the ones that are actively traded. That says first half of 2025. If anybody data checks me, I actually think I used July 3rd data. So a couple extra days there. But you can see the long funds were up slightly this year. It has been a higher volatility year in 2025. My favorite one is actually having a terrible year. SVIX, which gives you inverse exposure to what VXX does. Now, note that it's down a lot more than VXX is. The roll yield, because we've been in backwardation several days this year, VXX has benefited from that, and SVIX has gotten hurt by that because SVIX covers a short on the front month and shorts the second month. And if you do something like that on a day like that, if I've got to cover that short and short that one, that's going to hurt your performance. So we generally think that typically the roll yield works in our favor for the short funds. But because we've been in pretty dramatic backwardation a few times this year, SVIX has a hole to dig itself out of. And it's starting to work its way out of that hole. There's some funds in here as well, the midterm ones. they give you exposure to the fourth, fifth, sixth, and seventh month futures. I'm not going to go back to the curve, but typically those futures prices are all in line with each other. That part of the curve usually is flat, regardless of whether we're in backwardation or contango. So those funds have not gotten hurt too much by anything roll wise, and they've just benefited from higher volatility this year. That's why they've done that well. I was honestly shocked. I don't pay that much attention to those. I was actually really surprised to see the performance for VXE and VIXM this year. And when I'm on the Vol Views program on Friday, I will definitely be talking about that one. So last slide, we've been going. The VIX exchange traded products, they base their performance on a strategy and not the index. They may change in value even if VIX doesn't change at all. You have to be aware that there's some rebalancing going on from day to day. Sometimes they move opposite direction of what you would expect because of what's going on with the term structure. When you're thinking about trading anything, an ETF, make sure you know what's inside that ETF. And I mean, really, and you can look up what futures contracts and what the weighting of those futures contracts are every day, and definitely take that into consideration when you're thinking about trading those. So yes, you've got a question.
No, I have a comment.
Uh-oh.
No, I thought it was comical. But when you think about the 2008 crash, and when some investors started thinking about what was actually in some of those bundles and these mortgage-backed security bundles and
Mm-hmm.
starting to actually look at what the mortgages were, and those who were selling these products were, why are you looking? Why are you
Oh
engaged?
yeah.
Why do you want to know what you're investing in? So I
Nobody looks at that,
Nobody
but
looks at that,
yeah,
but I think your point is spot on. Of like, you should know what you're investing in. It
yeah,
doesn't matter what the product is. It doesn't matter how the product is being delivered. You should still know what the underlying is that you're actually investing.
absolutely. So don't just buy bonds because they have an inverse relationship with stocks because you think
Nope.
stocks are going to go down. If the interest rates are at zero, like in 2022, you're not going to make any money off your bonds. No wonder that
Right.
correlation, or no wonder that diversification didn't work. So there.
Right,
All
right, right.
right, we've gone a long time. You get to take us home because my voice is shot.
I believe it. But we thank you so much for doing this, because this was incredibly valuable. We covered a lot more than we do when we've talked about VIX in the past. So we'll talk about the implication of VIX if it's been up in the 20s or 30s. Those have been some more popular videos. But we
Mhm.
haven't gone through some of the nuances. And so just thank you so much for that, for
Oh, no
today.
problem. No problem
And
whatsoever.
yeah, and again, I hope that for everybody who watched, I thank you for watching the entire thing. I hope you got as much out of it as I personally did. And if you did, please hit like. And if you're not a subscriber, please hit subscribe. Because we covered so much, if there is something that you are interested in knowing more about, we just ask that you send a comment. And with that, we
Absolutely.
thank you, and we can't wait to see you next time.
Thank you very much. We appreciate it.